Right, next, I'd like to talk about the potential impact of the ECB rate cut that we have just seen recently and the strong jobs data on the US dollar. Okay, what's going to happen next, right? So on Thursday, right, the European Central Bank, aka ECB, implemented its first interest rate cut since 2019, despite the increasingly uncertain inflation outlook. Now, why do I say uncertain inflation outlook? Recent data indicated that the European inflation reduction has stalled, and they are also facing the same situation like the US, whereby wage and price increases exceedingly, with wage and price increases exceeding expectations. We have seen that. Now, this is something not only in the US, we are seeing it in Europe as well. Now, this has raised concerns that inflation might remain persistent, mirroring the situation in the United States. Now, the ECB President Christine Lagarde explained that although prices, particularly in the service sector, continue to rise, overall inflation has slowed considerably. The ECB projects headline inflation to average 2.5% in 2024, 2.2% in 2025, and 1.9% in 2026. So this outlook over here, what we see underpins the rationale behind the rate cut. They said because of this, our projections, we believe that it is prudent and it's safe to do the rate cut right now. Now, Lagarde also noted that there is typically a delay before rate policies effectively curb inflation. Now, this particular statement here, also we have heard it from Powell as well, only to see that, inflation remains to be sticky. Yet it did, for the US, it did drop significantly from 9 to 3, but it's always easy to drop from a high number, but as we come nearer to a lower number, it's not that easy. And we have seen that in US, and this possibly can also happen in Europe as well, right? And not only that, if you look at overall, this ECB data right over here, if you add into one more thing, if you believe that what Lagarde is saying, that said, okay, it's fine, we are still going to see price come down, then okay, fine, that's one part of it. We understand what's happening in Europe, but if you add in one other data, then it can start to form an idea how we should tackle the market next, right? So on Friday, the Bureau of Labor Statistics reported that the US non-farm payrolls increased by 272,000 for the month, considerably higher than the Wall Street consensus of 190,000 and well above April's comparatively muted gain of 165K. Now, I've mentioned before, any number above 200K is a good number for the US, right? So not only that, we are not only looking at the jobs over here, how strong they are. We know that they're strong, but can these jobs actually support, the inflation in the long run? So one particular area which could look at is the wages, right? The average hourly earnings though. So in addition, the average hourly earnings rose 4.1% over the past 12 months, more than expected. Now, this is something like we go like, wow, how is this? Jobs is increasing. Now we have also wages increasing as well, right? So beyond signaling a still vibrant labor market, the data at the very least adds to the narrative that the Fed doesn't have to rush to lower interest rates. As such, futures traders cut bets on rate cuts, which mean a stronger US dollars for now, right? So, excuse me, get a water. Pricing in the Fed funds rate futures pointed to almost no change of a reduction of either hope. Just hold on. Sorry. So pricing in Fed funds futures pointed to almost a no chance of a reduction to either the FOMC's meeting next week or the July 31st, okay? Is this week actually. From there, pricing indicates about a 50-50 chance of a September move. So we don't expect the June and July hikes there, right? And the September is a 50-50. And only about a 43% probability that the Fed will follow up with a second cut before the end of the year. So when I wrote this report yesterday, right, we had a 46% probability that the Fed will follow up with a second rate cut before the end of the year. And now, evening time, that has dropped to 43%. So although this number we cannot take it as for real, we cannot also discount the fact that with all the strong data that's coming out, there's a possibility that the Fed might not cut rates as much as they expect before, right? So I won't even be surprised if the inflation continue to prove being sticky, that we might not even see a rate cut this year, although Biden has already indicated that, yes, guys, there will be a rate cut. So we'll see. Okay. Now, what are the scenarios that could happen to the US dollars if the Federal Reserve maintain rates at 5.5% while the other central banks start cutting rates? Okay, we have seen that with the Canada and now the ECB. Now, first of all, the very first thing, we're going to see a widening interest rate differentials, right? So the interest rate differentials between the US and other countries would widen, obviously, making the US denominated debt more attractive. This could lead to increased demand for the US and further appreciation of the US dollars, right? And the second point is definitely the key talking point of it, which is inflation dynamics. Now, with the stronger dollar, imports would be cheaper, right? So cheaper imports could help keep inflation in check in the US, as lower import prices could counteract some domestic inflationary pressures. Next, increased capital flow inflows into the US could support financial markets, particularly equities and bonds, and investors seek high returns available due to the maintained higher interest rates. So that could also happen. And lastly, this is especially for the forex traders, that is the carry trade, right? So investors might engage in carry trade, borrowing in currencies with lower interest rates and boosting the demand for the US dollar. So these are the things that could happen, if what we see continue, after this FOMC, if we have a strong inflation and then Powell says that, look here, we have to be very data dependent on right now to make our decisions, and that just this simple word here could actually see the dollar strengthen. So wait for the CPI news, and that's the one that's going to give you this idea what to do next. Okay, so wait for that. So one thing's for sure, it is important to note that this relationship holds. You can use this relationship, which I just shared with you, the dollar strong, until the US begins its own rate cutting measures. At that point, the policies will need to be reassessed to determine the potential impact on the US dollars. Okay. So we just remember this particular area over here, right? Okay. Now, next,